Why bookkeeping quietly shaped every empire, business and fortune. Before spreadsheets, before accounting software, before banks and stock markets, there was bookkeeping. Every powerful civilization, from ancient merchants trading along the Silk Road to industrial tycoons building railroads, relied on one simple discipline: knowing exactly what came in, what went out, and what remained. Most people today avoid bookkeeping because they think it is complicated, boring, or only for accountants. That mistake costs small businesses, investors, and even salaried professionals more money than bad investments ever will. If you do not track your numbers, your money controls you instead of the other way around. In the next few minutes, you will learn how to set up simple, practical bookkeeping that gives you clarity, confidence, and control, whether you are running a business, investing, or just taking your finances seriously. Why bookkeeping is the foundation of serious money management. Bookkeeping is not about paperwork. It is about decision-making. When you know your numbers, you know when to spend, when to save, when to invest, and when to stop. Beginners often confuse bookkeeping with tax filing, but bookkeeping comes first. Taxes are calculated from records, not guesses. A clear set of books shows you profit trends, cash flow problems, and waste long before they turn into disasters. Even experienced investors return to basic bookkeeping because it reveals the truth behind the story money tells. Now, let's talk about how to separate personal money from business or investment money. The first and honestly most important step in easy bookkeeping is separation. Mixing personal and business money creates confusion and makes accurate tracking nearly impossible. So, you should open a separate bank account for your business, side hustle, or rental property. Every single dollar related to that activity should flow through that account. For example, if you own a small rental property, rent payments go into that account, and repairs, insurance, and maintenance come out of it. This single step instantly simplifies record keeping and, frankly, protects you during audits or financial reviews. Next, let's look at how to understand income, expenses, and profit without getting tangled up in accounting jargon. At its core, bookkeeping tracks three things: income, expenses, and profit. Income is simply any money coming in. Expenses are any money going out. Profit is what remains after expenses are subtracted from income. Beginners often overcomplicate this, but it really is that straightforward. For instance, if you earned $5,000 this month and spent $3,500 on operating costs, your profit is $1,500. That number tells you whether your efforts are actually working. Over time, monthly profit patterns reveal whether you are growing or, well, just staying busy. Now, how do you choose a simple bookkeeping system that fits your level? You do not need complex software to start. In fact, many beginners begin with a simple spreadsheet or even a notebook, tracking dates, descriptions, income, and expenses. As your activity grows, software like QuickBooks or Wave can automate calculations and categorize transactions for you. The key is consistency, not perfection. A simple system used weekly beats an advanced system ignored for months. So choose a method you will actually maintain. So, how do you categorize transactions so your reports actually make sense? Well, categorization is where clarity is truly created. By grouping similar expenses together, you can, start to see patterns emerge. Common categories include things like rent, utilities, repairs, marketing, travel, insurance, and professional fees. For example, if you notice your marketing expenses are growing faster than your revenue, that's a clear signal you might need to adjust your strategy. Investors, on the other hand, might track categories like mortgage interest, property taxes, and maintenance separately to really understand true cash flow. Clear categories turn raw numbers into, genuinely useful information. Let's talk about how to record transactions regularly so you can avoid those pesky financial blind spots. Honestly, the biggest bookkeeping mistake beginners make is waiting far too long to update their records. Transactions should be recorded weekly, or at the very least, monthly. When records are delayed, details get forgotten, and accuracy, it really suffers. Set aside a fixed time each week to update your books. Treat it like a business meeting with yourself. Over time, this habit builds confidence and, frankly, it eliminates a lot of financial anxiety. Now, how do you use bank statements to double-check accuracy? Bank statements are, in fact, your built-in audit tool. Each month, you'll want to compare your records to your bank statement to make sure every transaction is accounted for. This process, known as reconciliation, helps you catch missing expenses, duplicate entries, and the occasional error. For example, if your records show more cash than your bank balance, something was clearly missed. Regular reconciliation keeps your books honest, and most importantly, reliable. Bookkeeping, you see, supports much smarter tax planning and investing. Good bookkeeping does more than just track the past. It actually prepares you for the future. When tax season arrives, having organized books can really reduce stress and prevent you from overpaying. For investors, clean records reveal your return on investment, operating margins, and cash reserves. This data, it helps you decide when to expand, refinance, or perhaps even exit. Wealthy individuals, they do not guess. Now, how can beginners actually put this into practice right away? Suppose you run a small online business. You'd open a separate account, track all sales as income, categorize expenses each week, and review profit every month. Within 3 months, you'll know which products perform best and, importantly, where money leaks occur. Or imagine a rental property owner keeping track of rent, repairs, and mortgage payments. The numbers, quite frankly, reveal whether the property truly produces income or just feels busy. Why is mastering bookkeeping such a lifelong advantage? Bookkeeping is not just a beginner's skill. It's a lifelong advantage used by disciplined investors, business owners, and institutions alike. It creates transparency, accountability, and, of course, control. When markets shift or income changes, those with clear records adapt faster and survive longer. If you are truly serious about money, investing, and long-term stability, bookkeeping is simply not optional. It is, in fact, the language of wealth. Start simple, stay consistent, and let the numbers guide your decisions. If this guide helped you see bookkeeping a bit differently, do subscribe to the channel, share this video with someone building their financial future, and stay connected for more practical, timeless money knowledge.